The stock market is often seen as a battleground where everyday investors try to grow their wealth. But the reality is far more complex. Behind the scenes, a handful of powerful players control the market, influence prices, and determine economic trends. These entities include institutional investors, hedge funds, market makers, central banks, and even shadowy elite organizations that shape financial policies. Understanding how these players operate is essential for anyone who wants to navigate the market successfully and avoid being manipulated by forces beyond their control. At the top of the financial hierarchy are institutional investors, such as BlackRock, Vanguard, and State Street. These asset management giants collectively control over $20 trillion in assets, making them more powerful than most governments. Their ownership extends across nearly every major corporation, including tech giants, energy companies, and financial institutions. Because of their sheer size, when these firms buy or sell large volumes of stocks, they create significant price movements that affect the entire market. Their influence goes beyond trading. Since they hold major voting power in corporate boards, they can dictate company policies, shape corporate strategies, and even influence government regulations. One of the most controversial aspects of institutional dominance is their ability to manipulate stock prices. When BlackRock or Vanguard increases its stake in a company, it signals confidence to the market, causing the stock price to rise. Conversely, if they begin selling off shares, it can trigger panic among smaller investors, leading to a sharp decline in stock value. This ability to control market sentiment puts retail investors at a significant disadvantage. The average person doesn't have access to the same level of information, making it nearly impossible to predict or counteract the movements of these financial behemoths. Another major force in the stock market is hedge funds, which operate with a much higher degree of aggression and secrecy. Unlike institutional investors, hedge funds don't just invest in stocks for the long term. They engage in advanced strategies like short selling, options trading, and leveraged investments. Some hedge funds specialize in betting against companies, using their influence to drive down stock prices and profit from the decline. In many cases, they work closely with media outlets, analysts, and market influencers to shape public perception about a stock. By spreading negative reports or sensationalized news, they can manipulate the market and cash in on their trades. A well-known example of hedge fund manipulation occurred during the GameStop short squeeze of 2021. Several hedge funds had heavily shorted GameStop stock, expecting its price to plummet. However, a group of retail traders on Reddit's r/Wall Street Bets noticed the extreme level of short interest and collectively bought up shares, causing the stock to skyrocket. This resulted in billions of dollars in losses for hedge funds, proving that even the biggest market players are not invincible. However, the response from Wall Street insiders was telling. Trading platforms like Robinhood suddenly restricted buying of GameStop shares, protecting hedge funds while trapping retail investors. This incident highlighted how the financial system is structured to benefit powerful players at the expense of the average investor. Market makers also play a crucial role in stock price movements. These firms, such as Citadel Securities, are responsible for facilitating trades and providing liquidity. While their role is necessary to keep the market functioning smoothly, their insider advantage allows them to manipulate prices in subtle ways. Market makers can adjust bid-ask spreads, delay trade executions, or engage in high-frequency trading, HFT, to profit from microscopic price movements. Some analysts believe that market makers engage in front-running, where they use their access to order flow data to anticipate large trades before executing their own, ensuring profits while leaving retail traders at a disadvantage. The influence of central banks, particularly the U.S. Federal Reserve, adds another layer of complexity. The Fed has the power to set interest rates, print money, and directly intervene in financial markets. Over the past 2 decades, central banks have increasingly used quantitative easing, QE, to inject trillions of dollars into the stock market, inflating asset prices. While this has helped boost the portfolios of institutional investors and hedge funds, it has also created artificial bubbles that could collapse at any moment. The stock market is no longer a reflection of real economic growth, but a carefully managed financial illusion. controlled by those with the power to print money at will. A more controversial aspect of stock market control involves elite organizations and secretive financial groups. Some theorists suggest that a network of ultra wealthy families, global banking elites, and influential policymakers shapes stock market trends behind closed doors. Groups like the Bilderberg Group, the World Economic Forum, WEF, and other exclusive financial circles bring together the world's richest and most powerful figures to discuss economic policies in secrecy. While mainstream analysts dismiss these ideas as conspiracy theories, the undeniable concentration of wealth and power raises legitimate questions about who truly controls global finance. One of the biggest challenges for retail investors is navigating a market that seems rigged against them. Institutional investors have access to privileged information, hedge funds engage in high stakes manipulation, market makers control trade execution, and central banks dictate liquidity. The average trader, by contrast, is left trying to make sense of delayed information, manipulated stock prices, and sudden market crashes, engineered by those at the top. Despite this, there are strategies that individual investors can use to mitigate risk and take advantage of market movements. The rise of alternative financial platforms, decentralized finance, DeFi, and retail investing communities has given more power to everyday traders. By following smart investment strategies, diversifying portfolios, and staying informed about institutional movements, retail investors can level the playing field, at least to some extent. The stock market is often described as a game of winners and losers, but what most people don't realize is that the rules are designed to ensure that the biggest players always win. From market manipulation to coordinated bailouts, the system operates in a way that keeps the wealthiest investors on top while leaving the average person struggling to keep up. Understanding these dynamics is the first step toward making smarter financial decisions and protecting one's investments from the powerful forces that control the market. The real question is, if the stock market is just another tool for the financial elite, can the average investor ever truly win?